Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
When a stock moves 160% in a single day, trading 127 million shares, that is roughly half of the available float moving hands. You really have to stop and ask, what fundamental force has just been unleashed? We are, of course, talking about XAIR Inc., ticker XAIR, on January 13, 2026. The catalyst was this announced divestiture of its non-core asset, the NeuroNOS subsidiary, to XTL Biopharmaceuticals. So the question isn't whether the stock moved. The question is why. Did this one strategic pivot fundamentally transform XAIR from a distressed microcap that was, let's be honest, pricing in insolvency risk into a viable, high-potential turnaround? Or is this just noise, a temporary bridge over a very dangerous valley of death that the company still hasn't escaped? I'm going to argue that this deal is the game changer. It fundamentally alters the company's entire trajectory.
And I find that euphoria around the 160% pop to be, well, deeply deceptive. I come at this from a completely different angle. While the deal bought them some breathing room, a temporary cash infusion is not the same as structural sustainability. The volatility, to me, it just obscures the enduring, profound financial fragility of their business model. So my position is that, yes, the NeuroNOS sale provides a momentary tactical win, but it completely fails to solve the deep operational inefficiencies required to make their core product profitable. They were unprofitable before the deal, and frankly, they remain fundamentally unprofitable after it. So until they can generate cash flow internally, the massive risk of shareholder dilution, it remains a clear and present danger.
Okay, so let me articulate why this transaction is so crucial and why just looking at the $1 million in immediate cash it's missing the forest for the trees.
Their divestiture provides the single most critical resource they lacked: time. Before this deal, they were facing a literal countdown clock on two fronts: immediate liquidity failure and a very high probability of a NASDAQ delisting because the stock was trading so far below that $1 minimum. By rocketing above $1 and injecting that non-dilutive cash, the deal removes both threats. And that, in turn, unlocks the latent value of their core technology, LungFit PH. Okay, so let me articulate why this transaction is so crucial and why just looking at the $1 million in immediate cash it's missing the forest for the trees. The divestiture provides the single most critical resource they lacked. The real strategic win here is, well, it's the removal of the substantial R&D expense tied to that neurological drug development. That capital sink is just gone. XAIR is now a pure-play medical device company, focused 100% on accelerating the adoption of LungFit PH. And that system is designed to dismantle the archaic, expensive, and logistically burdened cylinder model that Malincrodot's Inomax has dominated for so long.
The market repriced the asset because the probability of default was just drastically reduced. The risk profile shifted from solvency to execution.
That's one way to frame it, I suppose. I would frame it very differently. While the company may now be a focused pure play, it is by every single financial metric a fundamentally unprofitable one. The financials, they speak to deep structural issues that a strategic pivot doesn't just resolve overnight. You celebrate the focus, but let's look at the operational reality, specifically the Q2 fiscal 2026 results. They reported only $1.8 million in quarterly revenue, yet they clocked a negative gross margin of $300,000. Think about what that negative number means for a second. For every dollar of LungFit PH they sold, they actually lost money just covering the cost of the goods. So scaling an unprofitable product, which is what they now have to do to grow revenue, that accelerates the cash burn. It doesn't solve it. And their liquidity position, it's still exceptionally tight. They had $10.9 million in cash, running a net cash burn rate of $4.7 million per quarter. They were burning through nearly half their cash every 3 months. Insolvency was a near-term,
And the deal provided the bridge.
a short bridge, yes. A very short one. Even with the pro forma liquidity bump to $22.9 million from the sale, management themselves guided a runway only through June of 2026. That timeline is razor thin. It gives them about 6 months to fix a fundamental profitability issue while trying to scale a commercial organization. That timeline, it forces them to keep relying on high-cost, very risky instruments like that 15% interest note, or even worse, the highly dilutive death spiral equity line they have with Streeterville Capital. I acknowledge the pressure on the balance sheet, but we have to discuss the strategic calculus here. The critical question is, does this deal provide just enough time to get to margin positivity? And my answer is yes, because the strategic benefits are so much greater than just that $1 million in cash. The critical question is, you're focused on the 4.7 million burn rate, but that burn was fueled in part by the NeuroNose R&D pipeline. The divestiture removes that capital-intensive component, a crucial operating expense saving, and that's on top of an existing austerity program where OPEX was already slashed by 37% year over year. The focus shifts entirely to commercial scale, but the savings have to be measured against what they need going forward. You can cut R&D, sure, but the SG&A spend, the sales force, the training, the logistics to place these machines in hospitals, that expense has to go up if they want to hit revenue targets. They have to spend money to capture market share, which just keeps that burn rate high.
It's a necessary investment, and the path to margin recovery is twofold. First, commercial scaling. They've already installed the system in over 45 U.S. hospitals and, this is critical, secured contracts with major group purchasing organizations like Premier and Viliant. Now, for listeners who aren't familiar, GPOs are basically massive buying clubs for hospitals. Securing those contracts is the golden ticket to mass market access. It reduces the sales hurdle dramatically. And second, the fundamental fix to the negative gross margin is the upcoming second-generation device.
And that is my exact problem. The entire financial rehabilitation of the company is hanging on a future product that is still far from market, and it requires perfect execution between now and then.
Well, the PMA supplement for the second-gen device was submitted to the FDA back in June 2025. That new version is specifically engineered to improve gross margins through lower manufacturing costs. The current device is expensive to produce because it was, in essence, a proof of concept. The second gen is designed for mass production efficiency, which directly addresses your core financial critique. The cash runway they bought with this deal isn't just about keeping the lights on, it's about enabling the transition until that lower-cost, higher-margin device can take over. They bought time to let superior technology solve the financial problem.
I'm just not convinced by that because it relies entirely on flawless future execution. It assumes no FDA delays, no manufacturing hiccups, and immediate uptake of a product that is, at a minimum, 6 to 9 months away. The reality is they have to transition that unacceptable negative gross margin to the 60 to 70% range typical of successful medical device companies, and they need to make that progress now. $22.9 million in pro forma liquidity is simply not enough, given the historical burn and the need to fund this commercial ramp-up. Failure to hit that key KPI, margin positivity, means they will be forced right back to that dilutive equity financing well long before the second-gen device ever sees the light of day. And that would neutralize any shareholder benefit from this deal.
But if they are forced back into financing, the valuation is now exponentially better than it was at 30 cents a share when the delisting risk was imminent. That stock price movement did more than just cure the delisting. It fixed the market's perception of their solvency and dramatically improved their bargaining position for any future capital raises.
That may be true, but let's be brutally clear about the financing mechanism you seem to be okay with them relying on. The Streeterville Capital equity line. I mentioned the death spiral. We need to talk about why that term exists, because this isn't just selling shares. It's a high-risk, toxic funding mechanism.
Right. Could you illuminate that for the audience who may not be familiar?
Sure.
So the agreement is structured so that XAIR can sell shares to Streeterville at a discount to the current market price. This creates a destructive feedback loop. If the stock price dips, say because of a slow commercial ramp, they are forced to issue exponentially more shares to raise the same amount of cash. This massive issuance dilutes all existing shareholders. And that dilution floods the market, putting even more downward pressure on the stock, which in turn forces them to issue even more shares next time. It's a vicious cycle. The deal only postpones their reliance on this instrument. It doesn't eliminate the underlying need for cash.
That's a fair point on the financial structure.
But the entire goal of the Neuronos deal was precisely to reduce the likelihood of having to trigger that spiral. They are now focused on a revolutionary product. But let's step back from the spreadsheets for a second. If the technology wasn't truly groundbreaking, none of this math would even matter, right? The value lives and dies with LungFit PH.
I agree. Let's talk about the technology, because I do acknowledge its technical superiority.
Okay, LungFit PH is not a marginal improvement. It's a paradigm shift from storage to generation of nitric oxide therapy. You look at the incumbent, Malincrod's Ionomax. It relies on these massive high-pressure cylinders. This forces hospitals to manage complex inventory, dedicate secure storage, and deal with all the logistics. If you run out of gas in the ICU, you have a clinical emergency. The Beyond Air device just flips this model on its head. It generates nitric oxide on demand from ambient air. They have a proprietary smart filter that scrubs the toxic nitrogen dioxide byproduct, a huge clinical safety hazard with the cylinder model, while allowing the therapeutic gas through. It offers essentially unlimited dosing, restricted only by electrical power. This is the definition of disruption. I will grant you that the core science is elegant. It is demonstrably superior in a lab.
But that's the point. We're not in a lab. We are operating in the highly conservative, risk-averse world of hospital systems and ICU physicians. The incumbent Malincrod, they may have archaic technology, but they've built a formidable defensive moat, a high switching cost through their total care service model. They provide 24/7 support, on-site training, maintenance, seamless integration. Their pitch is basically, we handle the complexity so your clinicians don't have to. But that total care model is required precisely because their cylinders are so complicated and fragile. LungFit PH fundamentally simplifies the workflow. It's an incredibly compelling economic argument when you consider the total cost of ownership.
The market has already shown my skepticism is warranted here. We saw management forced to slash their FY 2026 revenue guidance from a high of $16 million down to $8 to $10 million. That proves that the theoretical cost-benefit is secondary to clinical inertia. Hospital CFOs love the idea, sure, but the clinical staff are hesitant to adopt entirely new workflows for critical care when the old system, however archaic, is known and trusted. Inertia in this space is a powerful competitor that just burns through cash runway.
Inertia is real, yes, but it is overcome by superior economics, especially when you have GPO access. The revised guidance simply acknowledges the time needed to penetrate that conservative market, not a failure of the technology. The fact is they needed capital and time to withstand that slow adoption curve, and the Neuronos deal delivered both. And let's go back to the market signals. You dismissed the 160% price surge as just noise, a short squeeze? I submit that the sheer magnitude of that surge confirms the market was fundamentally mispricing the assets and solvency risk.
And that risk was real.
It was. But when short interest is as high as 21%, 1 in 5 shares betting on failure, and the stock is under $1, removing that delisting threat acts as a massive force-covering event. It wasn't just retail buyers. The removal of the compliance risk eliminates a huge psychological barrier for institutional funds who simply cannot hold sub-$1 stocks. This event forced those institutional shorts to cover, driving the price up. It was a structural re-rating.
I'm sorry, I just don't buy that it's purely a fundamental re-rating. That volatility spike is characteristic of a highly constrained float. And let's look where the sophisticated money is. We know that between 36 and 56% of the shorting happens off-exchange in dark pools. This suggests that sophisticated players remain bearish, using complex mechanisms to maintain their short positions. The exuberance you see on StockTwits is driven by hope, not by a validated income statement showing positive margins. And while CEO Steve Leasy is credited with successes like Avadel, he is a deal-maker first, and his operational forecasting has clearly been flawed, evidenced by the missed revenue guidance.
That distinction is fair, but you cannot discount the CEO's pedigree. He is a seasoned financial engineer from the highest levels, SAC, Millennium, Deerfield. He knows how to structure a turnaround, and crucially, how to manage the capital structure. His decision to sell Neuronos while retaining the equity upside is textbook capital allocation from a veteran, and his confidence is aligned with shareholders. Insider purchases are consistent. Lissy bought shares in 2024, more in 2025. Director Robert Carey bought shares in March 2025. Insiders are net buyers. They believe the market is severely undervaluing the company.
That may be true, but insider buys don't guarantee a profitable business model. The most compelling bear case remains the structural financial fragility. Until that gross margin flips positive, their reliance on that Streeterville equity line remains a ticking time bomb, ready to trigger that destructive feedback loop of dilution.
But the XTL deal was the catalyst to escape that immediate spiral risk. It shifted the company from facing imminent bankruptcy to one facing simple, manageable execution risk. Execution risk is a vastly better position for an investor, and the new structure gives management the bandwidth to focus solely on commercializing LungFit PH. The downside risk of total loss is materially reduced, and the upside remains massive.
And I maintain the company still sits firmly in that valley of death. The fundamental challenge of achieving positive gross margins and overcoming commercial inertia is not resolved by a $1 million payment. Until the income statement validates the business model with positive cash flow, the high cash burn will necessitate destructive dilution, regardless of the recent volatility. The operational friction is what will ultimately determine its fate.
Ultimately, the debate really lies in weighing the extension of the cash runway against that persistent operational friction. The deal bought them time, now they have to execute.
Exactly. We have highlighted the razor-thin margin for error. The listener really has to decide which factor, the tactical success of liquidity management or the persistent strategic challenge of achieving positive gross margin recovery, is the ultimate determinant of Beyond Air's success in the quarters ahead.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.